Opening the economy to foreign trade, both imports and exports, was another key reform that the government did. You must be knowing about Infosys' success story. Middle-class Indian entrepreneurs like Narayan Murthy and Nandan Nilekani took advantage of deregulation and India's emerging natural comparative advantage in the software and services sector in the 1980s. The company, which had been founded on the basis of $250 initial investment by a group of talented engineers in 1981, was a $4 billion company in 2008. Their comparative advantage was based on low-cost skilled English-speaking engineers who had been trained in India's engineering colleges. Infosys was an early globalizer and is an excellent example of world-class software services company. The sheer reason behind these excellent products and services is freedom to allow interplay of market forces operating in competitive environment, which forces producers to create best products in most competitive rates in order to compete with the best. Opening the economy to trade and foreign investment was an important objective of the reforms, aimed at reaping the potential benefits from greater integration with the world economy. As tariff levels came down and the pressure of competition from imports increased, Indian firms became more competitive by working efficiently in the value chain of production, which resulted in efficient utilization of resources, which finally benefited consumer with excellent product at least rates. Significant progress has been made towards this objective over the past 7 years by removing quantitative restrictions and lowering tariff barriers, though the process is not yet complete. Let's delve deeper into it by understanding 3 specific reforms in liberalizing trade policy, and they are dismantling quantitative restrictions, reducing tariffs, and exchange rate flexibility. Dismantling quantitative restrictions. India's trade policy regime before the reforms was heavily dependent upon the use of quantitative restrictions, QRs, in the form of import licenses, more than almost any other developing country. Imports of finished consumer goods were simply not allowed, and even inputs into production, such as raw materials, components, and capital goods were subject to restrictions through import licensing. The system began to be administered more liberally in the 1980s, with import licenses being much more freely given, but it remained restrictive and also highly discretionary. The first phase of dismantling QRs occurred in the first 2 years of the reforms, when import licensing was virtually abolished for imports of industrial raw materials, intermediates, components, and capital goods. By 1993, these categories could be imported freely, subject only to the prevailing tariff levels. However, agricultural products and industrial consumer goods remained subject to import controls. In 1998, a plan to phase out QRs on all imports within a period of 6 years was proposed by India in trade conference. This was accepted by all the major trading partners. Reducing tariffs. In addition to freeing imports from licenses, the tariffs on the imports were also reduced. India's trade policy before import duties, before the reforms, was characterized by import tariffs, which were among the highest in the world. Tariff rates have been lowered over the years, bringing the import-weighted average tariff rate for all products down from 87% in 1990 to 91 to 30% in 1998 to 1999. India's tariff reduction program, though still incomplete, has certainly created a more open economy with significant beneficial effects as Indian firms are being pushed to restructure their operations to become more competitive. Exchange rate flexibility. The removal of QRs and reduction in tariff levels described earlier would not have been possible without parallel changes in exchange rate policy. The rupee was devalued in July 1991 by 24% as part of the initial stabilization program, and a dual exchange rate was introduced in March 1992. The dual exchange rate was unified shortly thereafter in March 1993, and the unified rate was allowed to float. The cumulative effect of these changes was that between June 1991 and March 1993, the exchange rate depreciated from $1 is equal to Rs 20 to Rs 31, a depreciation of 35% in the dollar value of the rupee. This adjustment in the exchange rate clearly helped Indian industry to increase its exports, as now it got more funds in terms of rupees for any exports done. The flexible exchange rate regime has worked reasonably well, with the exchange rate responding to market conditions, while the Reserve Bank of India (RBI) intervenes periodically through foreign exchange sales and purchases or through monetary fine-tuning to maintain orderly market conditions. Exchange rate management has avoided the danger of excessive rigidity and also the opposite dangers of overshooting with associated loss of confidence. As part of the process of transiting to an open economy, India took measures to move towards the target of full current account convertibility in 1994 and accepted the corresponding obligations of Article 8 of the IMF. Following this decision, a number of steps have been taken to liberalize exchange restrictions on current account transactions. The United Front government in 1997 announced that the Foreign Exchange Regulation Act of 1973 would be repealed and replaced by a more modern Foreign Exchange Management Act, FEMA, FEMA.